Let's get Mohamed is with us. He had an article yesterday that you'd probably be really interested in, Steve, all about the Fed and worrying about moral hazard. I don't know how do we avoid moral hazard when we're all in. Anyway, Mohamed, I also want you to, since it's a big earnings week, you've said earnings will matter, and we just had a discussion with Anastasia about whether it's really is it a macro call on earnings, or do you look specifically at the details of each report? Because we basically, they're going to be painted with the same brush, mostly crappy. But whatever you want to opine on to start with, Mohamed, those are some of the companies that are reporting if you have a monitor. We're going to get a lot of data, but none of it's going to be very positive, probably.
So, Joe, let's put it all together. None of the data is going to be positive. To use Becky's term, it's going to be gloomy. But that's not the point right now. The point is that the markets are bridging to the future, and they're having to deal with the three issues you've been talking about. When are we going to reopen fully? How are we going to reopen? And can central banks in particular, and to a lesser extent fiscal agency, but for markets it's about central bank, bridge us to that point? Those are the three things that are in play. We're going to get a ton of information this week and next week on them, and it will allow us to make a much better assessment.
So tell me, are they going to be able to do that? What does it look like to you?
So it looks to me messy, and you're talking about the how. There's two hows. There's the top-down how, and look at us in the U.S. We have three groups of states. We have states that are adhering to the guidelines and reopening in line with the guidelines. There are states that are going ahead of the guidelines, and there are states that are going slower than the guidelines. So we have a natural experiment. That's the top-down. The bottom-up is the discussion you've had. It's not clear how businesses and consumers are going to respond. All I can tell you is this is wonderful. We're going to get lots of data. We're going to be able to form a better judgment about what's ahead. And we're all learning. We're learning here. We're learning in Europe. And we're going to learn more. And there's one thing we don't know, which is, will there be a second round of the infection? Hopefully there will not be. And we can run this experiment and get a lot of clarity. And that will give us a lot of guidance as to where valuations should be.
You think that the Fed sits around over the weekend thinking, wow, we've done all this, how's it going? Or what more are we going to be ready to do? They're probably talking about what more they're ready to do. What more can they do at this point, Mohamed?
So I think the Bank of Japan already did a lot this morning. The ECB is going to do more. I don't think the Fed does more. I think this is what we get from the Fed, and this is what we don't get. What we get from the Fed is reassurance that they're ready to do more in what they've already done, and that they should draw comfort that they've calmed the markets down and they've reopened not only the investment grade market wide open for companies, but the high yield market as well. Those are achievements. What they won't talk about, but I hope they do behind closed door, but they won't talk about publicly, is what do they do with the Fed put that is now firmly in the stock market? People rightly think if the Fed went all the way down to high yield, why not one step further into stocks? Do they keep quiet and allow that implicit Fed put support the stock market? Or do they say something to stop more moral hazard? I think they're going to avoid this issue. But this is important. Remember, central banks are great at winning the war against a market meltdown. They are not good about securing the economic peace of high growth. And that transition is really important this time around, as it was, and we blew it in 2008 and 9.
We've had people say not to worry. The dollar is the reserve currency of the world. We can basically, the Fed has an infinite capacity to step up and help. If everybody's printing, maybe the dollar doesn't weaken because of beggar thy neighbor. It's a race to the bottom. Will there come a time where the dollar weakens and interest rates, where it becomes prohibitively expensive to service everything that we floated at this point? And gold is where it was 7-8 years ago. I know it's had a nice run recently, but with the size of the fiscal deficits around the globe, I don't know why it's not much higher if we're really headed there. Why not?
So first, Joe, I've been saying for years now, don't fade the dollar, don't fade U.S. markets vis-a-vis the rest of the world. The U.S. does better in most states of the world, except one, when the global economy picks up in a strong way. That's not going to happen. So I'm with you. We're not going to see dollar weakness significant in the next year or two. We're not going to see interest rates go up. The MMT crowd, by the way, modern monetary theory, are having it all. They can't believe that what they want is playing out, and they're going to be proven right in the short term. We will print a ton of money. We will fund the government as if there's no limit, and we're not going to pay anything in terms of the dollar weakness, high interest rates, or inflation. So over the short term, I think we do better than the rest of the world. You know, gold is a really complicated asset price, and guessing it is very, very hard. I can see there will be continued support for it. Whether it's where it should be or not, Joe, I don't venture near gold. I don't venture near Bitcoin. You know, there's no inherent value that you can price off that easily.